On to the Money Show today, viewers. We're going to be talking about the NFOs as well as IPOs. Just to give you a perspective, NFO is a new mutual fund program that is suitable for those who are low to moderate having risk appetite. But for IPOs, which saw a boom in 2023, over 155 IPOs were launched in the year gone by. Majority of them were successful. And at this point in time, what should be your hopes or what should be a strategy going for further investment in the IPO space? So we will talk about that because we know that there are a lot of opportunities that you are looking forward to. However, IPOs flare against NFOs? What kind of fundamental analysis is required before investing in an IPO? What are the do's and the don'ts and you should be aware of before putting your money in either of these options? We will try to find an answer to all these questions with our special guest for today, that is Mr. Vivek Karwa of Riddhi Investments. Vivek, very good evening, and that's so great to have you onto the Money Show today. First of all, year 2023 has been a great year because we have seen back-to-back IPOs happening. People were so excited with some of the IPOs like IRDA, Tata Technologies, and in the NFO space as well, we have seen a lot of action. So just for the benefit of our viewers, if you could start by helping them understand the basic difference between them, and before putting their money in any of these schemes, what should be the key points that they should be looking at?
Good evening, Srishti. And this is an interesting comparison which we are going to do between NFO and IPO. See, basically, what is an IPO? IPO is as good as investing in an individual stock. And so basic difference is, see, you already have stock market wherein the stocks are trading on the secondary market platform on BSE and NSE, and you are able to buy or sell shares over there. So when a company is coming first time into the stock markets and wants to get listed, so right now we are talking about say Ola's of the world. So if the company wants to come and list, it is going to float an IPO, initial public offering, wherein the company will issue fresh shares, or maybe promoters would sell their shares, or maybe the PE investors generally come and try to sell their shares. So either ways, the public can invest in those shares and the company gets listed. So after listing, the company becomes a normal secondary market stock. So IPO, as I said, is as good as investing in individual company, wherein you got to do a lot of research, and particularly that becomes a risky game. And we might say that 2023 was a bumper year, definitely. See, what happens is, as and when every time, whenever the market is in bullish phase, we see that there are a list of IPOs which come up. So because it becomes very, very easy for the promoters to raise money, for the companies to raise money, because the sentiments are really good. And hence, a lot of companies line up their IPOs whenever the market is doing good. And you would have seen even this year, I don't remember the name, but one of the companies had to say stall its IPO and has postponed it because that time there was some sort of correction in the markets. So whenever markets correct, you will find that IPO market goes dry. And whenever the markets are bullish, you'll find a lot of IPOs coming in. So you got to be careful. When it comes to NFO of a mutual fund, see, basically what is a mutual fund? So mutual fund is collective investment scheme wherein the fund house collects investments from money from all the investors. And on behalf of the investor, there's a fund manager who is going to, based on the scheme of the things, going to invest into the stock market and create a portfolio on your behalf. So what happens is, when you invest in an NFO, it generally comes at 10 rupees NAV. And that's the reason, again, that also finds a lot of fancy with the investors. They think that, yes, 10 rupees is cheap, so let us invest in this NFO. First thing. Second thing, anyway, when you invest in that NFO, you get the expertise of a fund manager. So when you invest in an IPO, you might rely on other sources because you might not be able to do, as a layman investor, might not be able to do full kind of analysis which is needed to invest in an individual company. But when you do it in an NFO, the NFO is going to collect money and then later on going to invest into the markets. So before doing that, there's a fund manager who does all this job on your behalf. So NFO becomes a bit safer investment option compared to a IPO.
Thank you so much for highlighting the basic difference. But Vivek, in terms of like you were talking about the frenzy that people need to be cautious while putting their money in the IPO, and what we see is that people do come up with this question that is this a good company to invest in for a listing gain or not? So, what are the basic parameters that one should analyze for an IPO, and how should they decide that maybe this is the good time that they should look out for an exit after getting a handsome return from the listing? Because I was looking at the numbers, out of 58 IPOs that were there in 2023, almost 53 of them have given a positive return if somebody has got an allotment during the IPO. So definitely, yes, people have been rewarded well on that front, but still, how to have this view of a long-term investment and how to analyze these companies?
See, Srishti, again, I can substantiate when I say when the frenzy is high, people tend to lose money. Few examples, Paytm. So you know what kind of frenzy was there, and people lost money. There was a bank called Tamil Nadu Mercantile Bank. Again, lot of frenzy among unlisted space, but the stock has still not given returns. Then again, we can talk about Zomato. It gave a bumper return, but then almost halved after that. Now it is doing again good. So, and why forget Nika? So Nika also did the same thing. It came with really costly valuations, and then the stock had tumbled. So just going further, I will, for the investors to track, there's something called BSE IPO index. So which was on 1st April, approximately 7,700 points. And today it is approximately 12,600 points, which is almost a 62% gain on the BSE IPO index itself. So that index takes in all the IPOs which have come in last 1 year. So overall, the companies have given money. But what happens is sometimes uh, some companies are really ignored. And hence, you got to, when you are applying for IPO, please compare it with the peer group. How is the company doing? And it again becomes difficult for the layman to look into the history of the company, how many times the company has changed its name, how many times the company has changed the business model. So, okay, all those things are past. At today's pricing, whatever the pricing they're coming out with, does it compare and go good with the peer group? If peer group is trading, example, say 50 PE, and this company is coming at 60 or 70 PE, definitely the IPO looks costly. And investors need to keep this in mind that, see, the merchant bankers, the promoters, or the company, whichever is coming with IPO, they would always want to garner as much as funds possible and as much as valuation possible from the market. So that's the reason again I'm telling it is a difficult thing investing in IPOs. Yes, in bull market you tend to make money, but in bad markets you tend to lose money also on these stocks. So please always compare. And is the company generating free cash flows? This should be the number one point which any investor should look in, because when Zomato came in, when other new QSR type of companies came in with IPOs, they didn't have positive cash flow at all. They were in fact burning cash. And when the companies in unlisted space, they can keep raising funds from the PE investors. But once it becomes a listed company, that becomes difficult. And hence, these stocks had to see a good beating. So that's the reason. Please see if the company is earning profit, what is the net profit growth over last 5 years. All this data are available on the DRHP, which the company files, and what is the profit growth in last 5 years, and also if the company is generating free cash flows. Even if these three parameters, if you look at properly and invest, you will be much safer than, say, at least 90% of the cases, you'll be safer.
Well, thank you so much, Vivek, for highlighting what, as a thumb rule, you should check for before investing in any IPO. Do compare and have a fair valuation. Other than that, do look out for the cash flow. And Vivek also highlighted some of the red flags that you should be looking out for before making a decision. But Vivek, coming to the NPO, when is the time that one should look at that it is the time to take the money out, because it is still a mutual fund way? And what sort of a return expectation should one have? How to decide that this is the NFO that he should go and put his money in? So what's your advice on this?
See, there is very interesting thing which SEBI has done. SEBI has categorized the kind of funds you can come out with and have schemes in your AMC. And hence, most of these NFOs right now are just filling that space. So, and one more thing, when NFO is coming, generally even mutual funds try to raise and garner as much as AUM possible, and they generally come with NFOs in the space where there is a lot of noise. For example, if pharma is doing good, you might find pharma funds being launched. And if you find that EV is doing good, there might be technology fund and EV funds which might come up in future. So NFOs also try to do that. But NFOs, you are much safer. See, once you are investing, as I said, the fund manager takes care of the valuations, what he is investing, which company he is investing. He has a research team, and hence you are much more safeguarded, and you don't end up buying, say, companies which are too costly. That is one thing. And secondly, should you really come out of NFO if the markets are at high? Not necessarily. Generally, what happens is if a fund manager, assume I'm a fund manager, I'm investing in some company, and that company has given me phenomenal returns. In the mutual fund, what I would do is I would sell that stock, take that cash, and reinvest elsewhere. So this day-to-day information might not be shared with the investor, but as a fund manager, I also try to protect my value of the fund by doing this. So I would really sell what is costly and try to buy what is cheap. So automatically there is some kind of profit booking. And again, this is the greatest way of investing in stock markets, wherein you save a lot of say money by taxes as well. I'll tell you, mutual funds have exemptions on taxation front. So if you are a direct market investor, if it is short-term profit, you got to pay 15%. If you are long-term investor, you got to pay 10% as tax on the profits made. But if a mutual fund is selling some stock, they are exempt from that. And hence, if I'm investing, say 1 lakh, even if it becomes 1 crore, until I redeem the fund, I'm not going to be taxed, which is not possible in direct market. And one more point, Shrishti, investors who don't want to take much risk or cannot analyze the markets directly, IPOs particularly, which are coming in. There are mutual funds which are dedicated to IPOs also. That is, they invest only in IPOs. Okay. And as anchor investors, as an individual, I might not get an allotment, but as anchor investors, these funds get definite allotment, at least 100% allotment, not the quantity, some allotment at least they get. So indirectly, you participate in all good IPOs through the funds as well.
Okay, thank you so much, Vivek, for helping us understand the do's and the don'ts of NFO as well as IPOs. It was great having you on the channel. Thank you so much for your time.
Thanks, Srishti.
But with this, viewers, it's time to slip into a very short break in this edition of The Money Show. Don't go anywhere. We'll be right back to take your portfolio-related queries then, and those will be answered by our experts, so stay tuned for more. Welcome back to The Money Show, and viewers, we know that there are a plethora of funds that are available in the market to invest your money, but how do you assess that which is the right fund for your portfolio? And in order to guide you in a better way, today we have Shweta Jain of Investography. So do send us to your portfolio related queries on a WhatsApp number, that is 8657974571, or you can also email us your queries onto the email ID mentioned on screen. But with this, let's move forward and let's start getting your portfolio related queries answered by our expert today. First of all, Shweta, very good evening to you. The first query that I have is coming from Ravindra Pandey. His query is that what type of help will he get from you and your management in terms of, because he's looking for a long-term investment. Today, he's already investing in some of the shares as well as some of the schemes as well, wherein he says that his equity valuation is of around 31 lakhs. He's put in 83 lakhs in mutual funds, and other than that, in terms of the mutual fund, he is having his money in HDFC Hybrid Fund, HDFC Balance Advantage Fund, as well as HDFC Tax Saver Fund, and Axis Long Term Tax Saving and Axis Blue Chip Fund. He also has HDFC Flexi Fund, wherein he has put in his money, and he also has some fund in the senior citizen scheme as well. So he's touching around 70 years of age and wanted to stop some of these activities related to finance so that this could help as a regular income generation for his expenditure to be taken care of. What will be your advice for him as of now, that given the schemes that he has already put in his money, what will be your advice for him?
Hi, Srishti. Thank you for having me on the show. So my recommendation would be that he reassess the whole situation in terms of his cash flow, because this is something that they need to do when they're planning for retirement. So it's just not about the schemes, but overall what he needs to do. Having said that, I would definitely think he needs to cut down on his direct equity exposure and increase the mutual fund exposure, especially the hybrid schemes, where he can get regular monthly regular dividends basically. He has to also figure out if 30,000 what he's getting is enough. What is enough? Is it 40,000? Is it 70,000? Based on that, his portfolio revamping needs to be done. But at the moment, like I said, direct equity exposure, he should cut down, if not more, by at least 20%, and increase that by investing in hybrid schemes that give him regular dividends. He can, from a mutual fund side, I think he should cut down on the HDFC Flexi Cap for sure. And the tax saving funds, once they complete 3 years, that is when he can start moving them to hybrid as well. I would definitely recommend that he look at his overall asset allocation as well.
All right, so that's the advice coming in for Ravinder. But moving on in Shweta, we have a live caller named Venkateshan. Hi, very good evening, Mr. Venkateshan. Thank you so much for calling and connecting with us. Shweta is online. Please go ahead and ask your query.
Yeah, good afternoon. Myself, Venkateshan here. So this is about mutual fund strategy. This is about mutual fund strategy. Recently, I booked quite a good amount of profits from various mutual funds when the markets were going high and all that. And I was advised to get into multi-asset strategy or multi-asset funds category. I've been generally in, I thought, balance advantage funds or, hybrid funds or these kind of funds are swinging between equity and debt, and I should keep a ratio of all of this, and they do it by themselves and all of that. But now, in this current situation, at this point of time of the year or this situation, the advisor tells me that let's move into multi-asset fund category. I was even having a lots of asset allocation fund as I have in my portfolio, substantial part of it. But that was debt fund category. But this is kind of multi-asset strategy is equity doing the same job probably. Is it the right strategy or is it right advice? That's what I wanted to hear.
Okay, Shweta, you got his question. What will be your advice for him?
So it really depends on what kind of overall asset allocation he's looking at building, and how much does he want to be invested in equity, because really there are two different categories completely. One which has multiple assets. It could have gold. Does he need gold in his portfolio versus a balanced advantage versus a flexi cap? A flexi is something which is entirely equity. Hybrid will be more equity, less of debt.
Okay, I guess we have snapped this line with Shweta, but and we are also towards the end of this edition of the Money Show. But Venkateshan, we'll try to get an answer from Shweta, and we'll try to get that answer to you. But with this, viewers, it's time to wrap this edition of the Money Show. It was great. It's a goodbye from me and the entire team who put this show together. Thanks so much for watching.